I'm Rick Bleser, Vice President, Portfolio Manager at St. Germain Investment Management. Today we're going to look through a couple slides on the economy. As it was a pretty choppy quarter for the markets, we want to pull back the curtain and see exactly what happened out there. With that said, let's look first at the unemployment situation. So since we last came to you, there's been a continued good pace of hiring across the economy. We just clocked in at over 200,000 jobs for the fifth time in the past 6 months, which brought the average for Q1 above last year's Q1. So pretty good pace, and the jobless rate has been hovering about 5%. Now that hasn't declined any further because there are people now coming back to the workforce encouraged that things are a little bit stronger. So that labor force participation rate, as we'll see in the next slide, has begun to creep up a little bit. Speaking of which, the average hourly earnings, although up, haven't necessarily gained as much momentum as workers out there would like. We see today in this exhibit the paycheck for most people has increased at around a 2.5% rate. That's below what we saw back in 06 and 07 when the economy was really going strong and pay was increasing at a 4% clip. But it is off of the trough that we witnessed back in 2012. There's still a elevated level of underemployment, call it, where people are working an additional job or two. So full-time employment is still eluding many out there, and that's keeping overall wages still in check. Moving on and looking at industrial production, this has been a very complex story where you've had everything from foreign currency to certain industries like the energy space weighing on output and activity. So with that said, when we look at this exhibit here, you've got the sense that oil and the commodity price swoon coupled with that stronger US dollar as depicted in the green line have crimped industrial production in this country. It's actually declined 6 out of the past 7 months, and it is about 2% lower year over year. And even if we exclude the auto and the parts business, which is not shown here, activity remains quite restrained, fairly flattish since last summer. Against the backdrop of GDP that began the year last pretty decent pace through the summer and then finished on a soft note, we have got incomes, as just mentioned, that have trended up, and the consumer is benefiting at the pump, but retail sales have remained quite sluggish. So there's somewhat of a disconnect between how much money people are saving at the heating oil pump or their gas pump, and confidence is also stagnating surprisingly, with Q1 on average being below last year's Q1. And as shown in this chart, we are still slightly below pre-recession levels, almost there. We're approaching pre-recession levels with consumer confidence. Moving on to housing, that's experienced a very long and drawn-out recovery, and we've just recently had single-family units hit the highest level since very late November 2007. But further activity is probably required as supply remains quite restrained. And as evidence of that, if you look at existing home sales, those inventories are quite tight. They have not been appreciably higher since late 2014. And also pricing on average, whether you look at existing home sales or some of the pricing gauges reported by the FHFA or the Case-Shiller, they're pointing to recently 5% plus year-over-year increases. So it's a little bit of a mix between tight inventories right now and quite buoyant prices that are keeping first home buyers at bay and also keeping the housing market from probably taking off amid still pretty tight lending conditions out there from the banks. Lastly, the following slides will look at earnings for the overall S&P 500, so the largest 500 companies in America, and how they're expected to fare this year, and digging in a little deeper with the differences between those that focus on the US and those that focus internationally. So with that said, this exhibit here details how for the current year, S&P 500 profits are expected to be up very nominally, 2%, call it. And that estimate has deteriorated as the years progressed. Beginning at the January mark, analysts out there were expecting close to 7% growth for the bottom line of S&P 500 companies. This year, again, energy will remain a anchor on profit growth. And we also see here analysts took down their estimates very sharply. At the beginning of the year, consensus was for a 10% decline in earnings for the energy sector, and now analysts are expecting another 60% decline. There's a sense that U.S.-focused firms will perform probably better than internationally focused firms. For a primarily U.S.-focused business, their revenues are actually expected to be up about 3% this year. Earnings are not expected to be up, actually down 3%, but again, that's probably due to some of the energy space, the detraction there. However, compared to outside U.S. firms or focused firms, revenues for those firms are expected to be down 11%, with earnings contracting a whopping 19%. And if we look a little bit deeper and only at non-energy names within the S&P 500, revenues are again expected to be up about 2%, with EPS though about flat. So you can get a sense that the energy sector, with the volatile prices over the past year and particularly the first quarter, continue to weigh fairly heavily on that group as well as the overall market.